The trade war was originally initiated by the United States. Maybe this is just the midpoint of their overall strategy. Have you ever seriously thought about how the US was the one who first started the trade war? They certainly wouldn't have started it just to lose. Even though some people say, well, look at the statistical data points. This has really impacted American consumers, affected jobs, and negatively impacted economic figures. The trade deficit just keeps getting worse. It keeps getting deeper and deeper. Have you ever thought that was something like this? If we were just regular folks, even we could see what's going on. A lot of analysts can see it too. So why wouldn't a superpower like the United States, with all its resources, be able to see it? Of course they can see it, and they've probably thought it through to what comes next for the global economy and the US itself. What exactly does the US want? And even more than that, this could mean that the trade war or the tariffs and trade barriers that the United States started might only be halfway through their trade war strategy. What about the other half? Today on Sci Money Monster, we're going to try to predict what might happen next. You can support this video by scanning this QR code or support the Sci Money Monster channel easily by just clicking the button we've provided for you. Just click once, and that's it. Thank you. A lot of people are happy that the United States and China have finally agreed to shake hands and make a deal. After imposing trade tariffs on each other, the US reduced tariffs on China from 145% down to 30%, and China also lowered tariffs on the US from 25% to 10%. It sounds good, and it really does seem like a positive step. But a pause is just a pause. It's not a cancellation. Neither country has actually canceled anything yet. It's merely a brief pause, a temporary halt in the trade fight. The pause is only for a period of 90 days. And after that, all the uncertainty and unpredictability about what will happen next continues to remain for us to keep watching. Bloomberg also reported that UBS's wealthy clients are starting to shift their investments away from US assets. They're moving into assets like gold or various cryptocurrencies more and more. As for small business owners across the United States, they're currently facing a significant and challenging cash crunch. According to a recently conducted survey by Alignable, which polled 8,086 small business owners in the U.S. between March 13th and April 24th, the results clearly indicated that many business owners said that they themselves only have enough cash flow to keep their businesses running for less than 1 to 2 months. If you look at this chart, you'll see that 35% of small business owners in retail said in this survey that they have less than 1 month of cash left to manage their business, while another 57% said they have less than 2 months. For small restaurant owners, 32% said they have less than 1 month of cash left, and 56% have less than 2 months. As for those in the export business, 32% said they have less than 1 month of cash, and 52% said they have less than 2 months of cash left. And for furniture sellers, about 36% said they have less than 1 month of cash left, and 56% said they have less than 2 months. This means that the negotiations between the United States and China, where they've paused all trade tariffs for 90 days, or 3 months, still carry a lot of uncertainty and risk, as I mentioned earlier. So if after these 90 days the outcome isn't favorable, or if the outcome doesn't support economic activity between these two countries, the small businesses that were surveyed, those with less than 1 to 2 months of cash on hand, might not survive. On a national level, if we look at which countries are most heavily impacted, we should look at GDP growth. The IMF has reported that the effects of the trade war, whether during or after its announcement, have been significant. The country that was hit the hardest with the largest negative GDP growth was the United States, with a decline of 0.9%. So the question is, did the United States start this trade war just to lose? That's impossible. There's no way that's the case. If you look at media around the world, if you look at what analysts everywhere are saying, it's obvious that what happened hurt the United States the most. If the US couldn't see this coming, it would be strange, because if they could see it, they would have anticipated it before it even happened. Plus, America declared the trade war in a very aggressive way, but then suddenly backed off, agreeing to negotiate and giving in to China. So why back down? Why? Unless it's part of a strategy. Or maybe it means that this tariff and trade war is only halfway through. Is this an integral component of the broader strategy to make America great again? Because the other half might be a strategy to launch a full-scale currency attack. Let's take it step by step before explaining why the United States would need to launch a currency attack, or what exactly this kind of attack is. Should we first look at what the United States is truly aiming to achieve? What the US officially wants and has announced to the world is to rebalance trade, or in other words, to adjust the balance of global trade. But what America considers balanced might not be balanced for others, just to be clear. Everyone knows that the United States has been running a trade deficit for a very long time, for decades. If you look at the charts going back just 10 years, it's been a constant trade deficit, deep and getting deeper, the deepest ever. Until recently, the trade deficit reached negative $140 billion. Donald Trump once said that fixing the trade deficit isn't that hard because the US loses as much as $5 billion a day to China due to the trade deficit. If America just stopped buying things from China altogether, it would save $100 billion a year. Simple as that. Let's listen to what he said. Scott Batson, on the other hand, offered a somewhat more measured and soft-spoken perspective on the matter. He explained that rebalancing or adjusting the trade balance between the United States and China can be achieved in two very distinct and specific ways. The first way is for China to significantly reduce the volume of goods it sells in the US, or alternatively, for China to increase its purchase of various American-made products to sell back in China. Scott Batson said he fully expects that this agreement is an agreement that falls somewhere between these two options. He hopes that the US and China will be able to reach this agreement together. Let's listen to a bit of what he said. The real objective is to increase consumption and open up the Chinese market to American products so that American products can be sold there. The goal is to reduce the trade deficit as much as possible by making sure Chinese buyers and the Chinese market are more accessible. The idea is to test the market and some might think this sounds pretty simple, but it's actually not that simple. Let's break down the information a bit. First, the United States wants to rebalance trade with China. If the goal is just to rebalance trade with China, then why not just impose trade tariffs only on China? Why impose trade barriers on everyone? This suggests that wants to improve is the trade balance with everyone around the world. The idea is you can reduce the amount of your goods sold in America, or the US can sell more of its goods in your country. We'll negotiate that later. So if the United States says it wants to sell more American products to the rest of the world, what America needs to do is increase its production, so there will be enough goods to sell to everyone. And if the United States increases production, that fits exactly with what Donald Trump wants. Donald Trump wants to bring as much manufacturing back to America as possible. So the next question is, if America wants to bring manufacturing back to the United States as much as possible, where will it come from? The answer is simple: from anywhere, from all over the world. Now, let's think further. Suppose the United States manages to bring manufacturing back and can produce more goods, and then suddenly tries to forcefully say, hey, take these, buy my products, go buy my stuff in the United States, buy what I'm selling. It might come off as a bit too forceful to try to make someone take our products and sell them in their country. At the very least, we need to make them feel like they're getting some kind of benefit from selling our products in their market. So for any country that wants to focus on exports or increase their export volume, you have to run promotions, offer discounts. But when it comes to discounting at the national level, you can't just suddenly say, Hello, today we're running a promotion. Buy one, get one free, or 10% off. But that's not how it works. You can't do that at the national level. There's really only one way to run a nationwide price promotion, and that's by devaluing the currency. As soon as you devalue the currency, all products from that country instantly become cheaper. No need to put up any promotional signs. Just lower the currency value, and the exporting country can sell the same amount of goods, but at prices that seem cheaper to their trading partners. So if that's the case, okay, just devalue the dollar, right? But manipulating the currency isn't something you can just do whenever you feel like it. There are mechanisms, processes, and international agreements in place. But the important thing is, if the United States were to devalue the dollar, other countries would be in trouble because the dollar is the currency that's tied to so many others, to every currency around the world. That includes the Thai baht too. So if the US dollar weakens significantly, the other currencies, everyone else's money, will automatically get stronger. Right now, it seems like the United States has started negotiating currency matters with other countries. For example, the US has begun talks with South Korea about exchange rate policies, which has caused the Korean won to strengthen against the US dollar immediately. Another currency that's experienced a very significant and noticeable impact is the Japanese yen, which has strengthened by about 2% in a span of only a few short days. Whether it's the won or the yen getting stronger, this effectively adds an additional and burdensome layer of cost on top of the trade tariffs that the US has already imposed. So if consumers in the United States want to import goods from Japan or South Korea right now, not only will they have to contend with the financial burden of the tariffs, there's also the 10% trade barrier that the US has put in place, plus the weaker dollar compared to these two currencies, which makes things even more expensive. This means that people in the United States, regular consumers, won't want to buy goods that have become more expensive when they're getting the same thing as before. The impact on consumers when it comes to buying things like this might sound minor or hard to picture, but these so-called minor issues are actually a big deal because when you add up all the little things, it adds up to something huge. For example, in Japan, the impact has been especially strong. Japan is one of the direct competitors of the United States in car exports. The trade tariffs imposed by Donald Trump have caused Toyota, the #1 car company in Japan, to lose almost $1.3 billion in operating profit. Toyota has also projected that, because of this policy, its annual revenue will lose $10.7 billion this year. While there will still be annual profits, they are expected to drop by as much as 21% compared to last year. And it's not just Toyota in Japan. Yes, Toyota is the biggest, but other car companies are affected too. Bloomberg even made a chart comparing all the Japanese car companies, and it shows that every single one is impacted, though Toyota is hit the hardest. Altogether, the 5 major car manufacturers in Japan could lose a combined annual revenue of $19 billion. And the Japanese economy isn't doing well to begin with, so when car companies lose this much revenue, it's going to hit Japan's economy even harder. Even before this issue, Japan's economy wasn't in great shape. You can see that Japan's GDP since Q2 of 2024, before Donald Trump announced any trade tariffs or protectionist measures, was already showing signs of decline. Then, moving into 2025, when Donald Trump came into the picture, Japan's GDP in the first quarter actually dropped, down by 0.7%. Japan's GDP has declined for 2 consecutive quarters, which technically means the country has entered a recession. And if the US dollar weakens even more, or if the yen appreciates further, Japan's export sector will suffer even more. This could impact GDP growth, making it even lower, and the Japanese economy will likely continue to struggle. It could get even worse than this. Since the beginning of the year, when Donald Trump took office, the value of the US dollar actually dropped to its lowest point, a decline of 9.5%. You see, a currency doesn't just weaken overnight. For it to drop by 9.5%, it's likely that there was some planning involved. The weakening started at the beginning of the year, combined with the US's efforts to negotiate with other countries, like South Korea, to actively adjust their exchange rate policies to weaken the dollar. It's possible that what's happening now is a direct repetition of history, specifically the Plaza Accord that took place in 1985. Back then, the United States held a meeting with the G5 countries, which included leaders from France, Germany, the UK, and Japan. The 5 countries reached a formal agreement, with the United States taking action to reduce the value of their own currencies in order to make the United States more competitive or to boost exports. As a result of the Plaza Accord, the yen appreciated by as much as 50% against the dollar within just 2 years. This immediately caused problems for Japan's exports, especially cars, because Japanese exports became expensive. Japan's main source of income was heavily dependent on car exports. So when exports ran into trouble, what followed was the significant collapse of Japan's car export industry. In 1985, the year the Plaza Accord was signed, Japan's export industry growth rate was as high as 15%. But just 3 years later, the remarkable growth rate of Japan's car export industry dropped from 15% to a mere 1.4%. At that time, it might have been because Japan didn't really have experience in making agreements or adjusting exchange rate policies or changing currency values. Right after the agreement was reached, Japan's economy wasn't bad from the start. Because once the agreement was done, right? Okay, the yen appreciated, the dollar weakened, which meant Japanese people actually became wealthier. Even though exports declined, imports became cheaper, right? So Japanese people, they felt richer, so they started buying more goods from America. There was more travel to the US for tourism, and they even went as far as buying American companies and businesses. Basically, they invested their money in the United States. So in a way, Japan was sending more money to the US, which played right into America's hands, since they wanted more investment anyway. But this also meant that Japanese people were spending more, while their income was decreasing because exports were doing worse. At that time, Japan's economy entered a bubble phase. The stock market hit an all-time high, peaking in 1989. The Japanese stock market once reached as high as 39,000 points, but because expenses were extremely high and income was low, Japan's bubble burst as soon as it hit that peak. The Japanese stock market then took a sharp downturn. Just 4 months later, Japanese stocks had dropped by 30%. Then it dropped to a negative 60% in 1992, and by 2003, it had fallen to a negative 80%. The highest point after that was in 2007, right around the time of the hamburger crisis. Because of these events, like the Plaza Accord happening, combined with Japan's already struggling economy and the bursting of the bubble, Japan ended up entering what's called the lost decade, which actually lasted 30 years, or 3 decades. And even now, it still doesn't look like Japan is anywhere close to getting out of this lost decade. Or the ongoing trade war and the announcement of protectionist tariffs, those are just half of the United States' strategy. The other half, from here on out, if it really turns into an attack on currency values, then there's a possibility that the global economy could repeat the history of the Plaza Accord. This video is just a prediction, though. It may or may not turn out this way. But I think that if things really do go this way, and the second half of the strategy is a currency attack, then what everyone should do is, if you thought the recent trade wars and protectionist measures were intense, manipulating currency values to attack other countries' economies could be even more severe.